He was eating the same breakfast he'd eaten for 40 years, a McMuffin, a Coke, and a newspaper, worth $90 billion. And somehow, that's the part that breaks people's minds. Not the 90 billion, the breakfast. Because everything we've been taught about wealth looks like excess. Private jets every day, wardrobes refreshed every season, a new watch for every mood. We were handed a map where success means visible spending, where arrival means display, where the destination is the thing you can post. Warren Buffett drew a completely different map. And the strangest part, he's been sharing it for decades. In shareholder letters, in interviews, in offhand comments at Berkshire Hathaway meetings in Omaha, Nebraska, a city most billionaires couldn't locate on a map without help. He's told anyone who would listen exactly what he did, exactly why it worked, and exactly what most people are getting wrong. And most people nod and walk away and do the opposite. That's not laziness. That's not stupidity. That's something deeper, something structural, something that runs underneath the surface of every financial decision you make, every career move you delay, every investment you almost made but didn't. There's a hidden architecture to the way most lives are built, and it is working against you, whether you know it is or not. This script is about that architecture. 5 rules, 5 ideas that Buffett has lived by, not talked about living by, actually lived. Rules baked into his routine, his portfolio, his relationships, his way of reading the morning paper. But here's what most breakdowns of these rules miss. They aren't just money rules, they're structural rewrites. Each one dismantles a default setting that most people never question. The 5th rule is the one nobody sees coming, and it's probably the one that explains every other decision he ever made. We'll get to that, but first, you need to understand something about the water you're swimming in, because until you see the current pushing against you, you'll keep blaming your own stroke. There's a force, quiet, invisible, and completely relentless, that governs the financial lives of most people. It doesn't care about your work ethic, it doesn't care about your intentions, and it's not going away just because you found a motivational video. Understanding that force is where everything starts. Think about gravity for a second. Not as a metaphor yet, just as a physical fact. Gravity is the most ordinary thing in the universe. You never think about it. You wake up, your feet hit the floor, and you go about your day. Gravity is invisible, constant, and completely in charge. You can jump, you can run, you can build a ladder, but if you stop, gravity wins, always. Now think about your financial life. Most people operate in what we could call a linear life. Income comes in, expenses go out. A little bit, if you're disciplined, stays in a savings account earning next to nothing while inflation quietly erodes its purchasing power from the inside. Every year, you trade time for money, and every year, the price of everything goes up a little. The cost of being alive climbs a little, and the gap between where you are and where you want to be stays roughly the same. That's gravity. That's the default current. And the terrifying part is that most of the systems around you, banks, advertisers, employers, even well-meaning family members, were built to keep you inside that current. Not maliciously, just structurally. The current is where the economy needs most people to stay to function. Warren Buffett understood this before most people had a vocabulary for it. He didn't call it gravity, he had quieter ways of explaining it. He talked about the difference between working for money versus having money work for you. He talked about sitting under a tree you planted 20 years ago. He talked about buying a business, not renting a job. The metaphors change, the principle is identical. There's a default system, and then there's a completely different system, and the second system does not announce itself. You have to choose it, build it, and protect it with intention. Here's how to think about the two systems. In the first system, you are the engine. You wake up, you produce, the money flows. You stop, the money stops entirely. Every dollar you have is 1 hour of your life that can never come back. In the second system, assets are the engine. Things you own, businesses, partial stakes in businesses, real estate, intellectual property, produce while you sleep. You still work, but you're building something that keeps going when you're not pushing it. Buffett called it compounding. He called it the snowball. He said the key was finding wet snow and a very long hill. Most people never find the hill, not because the hill doesn't exist, because nobody told them they were supposed to be looking for one. That changes now. There are 5 rules, 5 structural rewrites that Buffett embedded into his actual life, not inspiration, architecture. And each one does something specific. It takes one piece of the gravity system and reverses its pull. The first rule is so simple it sounds wrong. The second is about an edge that most people actively destroy before they're 30. The third involves a calculation most people never make, and it's shocking when you see it. The fourth goes against every social pressure you've ever felt. And the fifth is the one that makes the other 4 possible. Think of them as 5 gears. Each one you engage, the engine gets more powerful. But there's a reason most people never engage any of them, and that reason has nothing to do with intelligence. Let's engage gear 1.
Rule 2. Invest in what you understand and know where your edge actually lives. Most people never seriously invest, not because they lack money, although that's a real barrier and we'll address it, but because they're waiting for clarity that will never arrive. The market is too uncertain. The timing doesn't feel right. There's always a news headline that makes everything feel too dangerous. And so the money sits in a savings account or gets spent on something that at least feels solid, even if it's worth nothing in 10 years. Buffett had a name for his clarity system. He called it the circle of competence. It's an elegant idea, deceptively simple. Here it is. Know what you know what you don't know, and for the love of everything rational, do not pretend the line between those two things is further out than it actually is. He drew an imaginary circle. Inside the circle, industries, businesses, concepts he genuinely understood, how they made money, what threatened them, what made them durable. Outside the circle, everything else. And his entire investing philosophy was built around a single discipline: stay inside the circle. No exceptions for hot tips, no exceptions for trends that everyone seems excited about, no exceptions for the fear of missing out. This sounds obvious until you realize how aggressively everything in the modern world is designed to push you outside your circle. Here's the story of the dot-com bubble. The late 1990s, every investor in America was piling into internet stocks, companies with no revenue, no profit model, sometimes no actual product. Their valuations were climbing to the sky. Warren Buffett, worth billions already, did not buy a single one. His investors were furious. He was called a relic, out of touch, too old to understand the new economy. A major financial magazine ran a cover story asking if Buffett had lost his edge. Then the bubble burst, and Buffett, who had been sitting in the dirt outside the party, came out of it with his capital largely intact, while others lost everything. He didn't avoid the crash because he was smarter than everyone. He avoided it because he honestly admitted he didn't understand internet companies well enough to assess their value. He didn't know where his circle ended. Wait, he did know where his circle ended, and he respected that boundary even when it felt embarrassing. That is the circle of confidence in practice, and it has a mirror principle that almost nobody follows. If staying inside your circle is the defense, expanding your circle is the offense. Buffett reads, famously, obsessively, daily. He has said that he spends a significant portion of his day reading filings, annual reports, newspapers, books, biographies, not scrolling, not consuming content at playback speed too. Reading with attention the kinds of primary sources that build genuine understanding. He said that reading is how you build the circle larger over time. Every concept you deeply understand is a new tool. Every industry you genuinely grasp is a new opportunity available to you that isn't available to someone who only skimmed the headlines. On screen, an animation of a small circle slowly expanding as books stack up, each new ring representing a new domain of competence. Here's the hidden penalty for ignoring this rule. When you invest in things you don't understand, you are completely at the mercy of your emotions. When the stock drops, you don't know if it's a sale or a disaster, so you panic and sell. When it rises, you don't know if it's overvalued or still cheap, so you hold too long. Without understanding, you are navigating entirely by feeling, and the market is specifically structurally designed to weaponize your feelings against your returns. Understanding is not just intellectual satisfaction, it is armor. The exit step here is humble and powerful. Get specific about what you actually understand, not what you wish you understood, what you genuinely, deeply could explain to a 12-year-old understand. Start there, build from there. Buffett didn't start with massive international conglomerates. He started with candy companies and newspapers and regional banks, simple businesses with predictable economics that he could read like a clear window. Your circle is smaller than you think. That's okay. The dangerous delusion is thinking it's larger than it is. And here's what makes the circle almost impossible to grow for most people in the modern world. It's not lack of books, it's not lack of access to information. It's something that Buffett guards with the ferocity of a man who has spent a lifetime watching other people destroy theirs without realizing it. Rule 3. Guard your time like it's your only real asset, because it is. This is the rule that lands differently once you do the math. Here is the math. You have roughly 4,000 weeks in a human life. That's it. Not a dramatic estimate, an ordinary statistical reality, 4,000 weeks. And here's what makes it colder. About the first 1,000 are childhood, where you have very little agency over how they're spent. The last several hundred, depending on health, are often reduced in energy and capacity. So the window, the real window of high agency, high energy, high choice time is narrower than 4,000 weeks. Most people never do this math, and so they spend time with the casualness of someone who thinks the supply is infinite. Buffett does not treat time this way. He has an almost radical simplicity of schedule. He doesn't take meetings he doesn't want to take. He doesn't say yes to things out of guilt or social pressure or FOMO. He reads in the morning. He thinks. He talks to people he finds genuinely interesting. He protects blocks of unstructured time in a way that would look, from the outside, almost lazy. But that unstructured time is the factory. That's where the thinking happens that produces the decisions that compound into outcomes. There's a famous story, famous in business circles at least. A pilot once showed Buffett a goal-setting exercise. Write down your top 25 goals. Circle the top 5. Everything you didn't circle, that's your avoid at all costs list. Not your secondary list, not your when I have more time list, your never do this list. Because those 20 items are just attractive enough to keep you busy without moving the needle on the 5 things that actually matter. That is the time diffusion trap. It doesn't look like distraction, it looks like being busy, it looks like productivity. There is probably something in your week right now that makes you feel productive but produces almost no real value. And because it produces some value, it justifies its presence on the calendar. And because it's on the calendar, the things that could produce 20 times more value never get the real, focused, uninterrupted time they need. On screen, visual of a calendar where small, low-yield activities slowly fill the entire grid, pushing a single high-value block into a tiny corner until it disappears. The hidden penalty of the time diffusion trap is compounding in reverse. Every year of a high-leverage skill, business, or investment doesn't get your best hours is a year you don't get back. The math is identical to the financial compounding math, except instead of interest, it's capability. Skills compound, understanding compounds, relationships in your field compound. Every year of serious,
focused effort in a direction that matters builds on the year before it. Every year of busyness does not. Buffett once said that the difference between successful people and very successful people is that very successful people say no to almost everything. That line sounds like an exaggeration until you calculate the cost of all the things you said yes to in the last year that neither moved you forward nor filled you with genuine joy. The exit step is simple and also difficult and also completely available to you starting tomorrow. Take your week. Look honestly at everything in it. Ask, is this building toward an asset, a skill, a relationship, a business, a body of work, or is it just spinning? Not everything has to be strategic. Life has joy in it that doesn't need to justify itself economically. But the things that are neither strategic nor joyful, those are eating the time that could change everything. Protect the factory. The factory is your focused hours. Now here's the irony of everything we've covered so far. Living below your means, staying in your circle of competence, protecting your time, choosing your environment, building your skills, none of it sounds revolutionary. All of it any intelligent person would agree with if you put it in front of them. And yet almost nobody lives by it. Not because they're failing, because there's a force working specifically against these behaviors, a force that is social, psychological, and almost entirely invisible. Rule 4. Choose your environment like your life depends on it. It does. Here is a claim that sounds almost too large. The 5 people closest to you have probably had more influence on your financial life than any book, any course, any motivational video, or any strategy you've ever encountered. Not because they're telling you what to do, because they're setting the baseline for what feels normal. There's a principle in behavioral economics, and studies across multiple disciplines keep pointing back to it, that human beings are, at a fundamental level, social calibration machines. We look at the people around us to figure out what's acceptable, what's ambitious, what's excessive, what's enough. The reference point isn't abstract, it's your actual social world. So here's if your circle of competence includes any business, any industry, any domain well enough to assess value, that's where you start looking. Not for the exciting opportunity, for the boring, durable, understandable one. Buffett didn't start by buying entire companies. He started by buying small stakes in businesses he understood deeply, at prices that gave him a margin of safety. The scale was tiny, the logic was sound, and the logic, compounded over time, became everything. You can start with an index fund if your circle isn't specific enough yet. Buffett has said that for most people, most of the time, a simple index fund, buying a small slice of hundreds of businesses rather than trying to pick individual winners, is a perfectly rational and historically sound choice. It is better to own the market broadly than to pick individual stocks outside your circle of competence and lose. But the goal is to expand the circle, always, so that over time you see opportunities that a less informed version of you would have missed. And change one relationship in your environment, just one. Find the one person or the one community where the conversations are operating at a level that challenges you, where investing is normal, where building is expected, where patience is understood rather than mocked. Proximity to that conversation rewires the baseline, and the baseline is, in the long run, destiny. Stage 3, escape velocity. This is where the compounding becomes visible. You've been running the engine long enough that the output starts to exceed the input. Your skills have compounded to the point where your earning capacity has meaningfully increased. Your assets, however modest at the start, have been growing and have started to generate their own momentum. Your environment has shifted enough that the behaviors that used to require enormous willpower now feel like the obvious natural thing to do. Escape velocity, in physics, is the speed at which an object breaks free of gravitational pull. It's not infinite speed, it's a specific threshold. You hit it, and the energy required to keep moving forward drops dramatically. The financial equivalent is the point where your asset income, what your money makes, begins to cover a meaningful portion of your basic expenses. Not everything, not retirement, a portion, because at that point, the calculation of your life changes. You're no longer entirely dependent on trading time for money. You have leverage, you have options. You can take a risk on the thing you've been building. You can say no to the opportunity that doesn't fit the circle. You can think with the long-term clarity that Buffett described, the clarity that comes when you're not scrambling for next month. This is the snowball on the long hill. This is what Buffett described, and it does not require a genius IQ or a privileged starting point or a lucky break. It requires the 5 rules applied with patience, in sequence, over enough time. Most people never start because stage 3 seems impossibly far from where they are. But stage 1 starts tomorrow. And stage 1 is not about being wealthy, it's about being stable. And stability in a world of compounding is the beginning of everything. Here's what this all reduces to, quietly, simply. Warren Buffett ate a McMuffin for 40 years, not because he couldn't afford anything else, because he had decided a long time ago that his life would be measured by what he built, not what he displayed. That his identity was not the house or the watch or the car, but the judgment he developed, the assets he accumulated, the principles he kept, even when they made him look out of step with everyone else. He stayed in his circle, even when the whole world was telling him to step outside it. He protected his time, even when busyness would have been more socially comfortable. He changed his environment quietly, deliberately, without apology. He built his skill stack over decades with the patience of someone who actually believed in compounding, not as a financial concept, but as a way of life. 5 rules, not hacks, not shortcuts, architecture. The gravity is still there. It will always be there. The default current of the world is real, and it's powerful, and it is pulling toward consumption and noise and the short term and the visible and the ordinary. It doesn't stop just because you've read this, but gravity has a response. It's called lift, and lift isn't magic. It's structure applied consistently over time until the force working against you is smaller than the force you've built. Buffett found his lift decades ago. You know exactly what it was made of. The question isn't whether the rules work. The question is which morning you decide to start building.